This is the Human Action Podcast with your host, Dr. Bob Murphy.
Welcome, everybody, to another episode of the Human Action Podcast. I am one of your standard co-hosts, Bob Murphy. Jeff is not with us this week, but we do have a special guest, Ross McKitrick. Ross, how are you doing?
I'm doing good, thanks, Bob. How are you?
Great. So Ross is an old colleague of mine that I know from Canadian circles. So let me just share with you folks a little bit about his official background, and then I'll talk about what we're going to get into today. So Ross McKitrick is a professor of economics and the CBE Fellow in Sustainable Commerce at the University of Guelph, where he specializes in environment, energy, and climate policy. And he's also a senior fellow of the Fraser Institute. But today, what caught my eye is Ross had written an article on inflation, and it was something that coincided with my own interests and something I had been worried about. So specifically, just to set the stage for you folks at home, now that consumer prices are exploding here in the United States, the highest, since the early 1980s, and they're also doing so in Canada as well. And it's standard for those of us of a free market persuasion who are skeptical of central bank policy to say, well, gee, they printed a bunch of money, both physically and electronically, following the 2020 coronavirus panic. So what do you think is going to happen? This is standard Econ 101, folks. But my concern with just being too glib on that was, well, yeah, but some of us, including me, were saying similar things back in late 2008, 2009, when the Federal Reserve also unleashed a torrent of monetary inflation following the financial crisis in the fall of 2008. And as we know, at least official measures of the consumer price index didn't explode. And it's true, we can come up and say, oh, well, they suppressed the numbers. And yeah, that's all true. But gasoline in the United States was not $5 a gallon in 2010. And yet it is now, and much higher in some places. And so the question is, why was it that the Fed's actions or the Bank of Canada's actions in the wake of the financial crisis in 2008, which again at the time was unprecedented, what they did, just loading the system up with money, how come that didn't lead to huge spikes in CPI, the highest we'd seen in decades at that point, and it allowed Keynesians like Paul Krugman and Brad DeLong to run victory laps and say, see, these guys are idiots. They don't know anything about how money works and prices, at least in a modern economy. So what caught my eye, like I said, is that Ross recently in the Financial Post, back on May 22nd, has an article titled Inflation, Why Now and Not Post-2008. So Ross, do you want to take the helm for a minute and just explain what your analysis was? Like, why was there discrepancy between what happened then and what happened now?
Sure. So my reaction to 2008 was similar to yours. Just watching the numbers on the U.S. monetary base, it had just drifted upwards really for decades and was at about 800 billion just prior to the financial crisis. And then the financial crisis took the form of a lot of assets in the financial system suddenly losing their value, just collapsing altogether because of the structure of the mortgage-backed securities. And so Ben Bernanke, the head of the Federal Reserve, his response was really revolutionary. He just essentially opened a window and said to the banks, sell me whatever you like and I'll give you par value for it. And to pay for that, he rapidly increased the money supply. It hit $2 trillion by 2010. And so that was more than doubling the size of the money supply in a very short period of time. And so, yeah, those of us watching it, thinking of just the standard macro theory, assumed, oh, that money is going to create inflation. To understand why it didn't, you have to look at some other accounts. First of all, the velocity of circulation had been going down previously, and it just kept going down. So that was dampening some of it. But also the big thing was the banks didn't lend the money out. They put it into an account called the excess reserves account at the Fed. And the excess reserves account looks a lot like the monetary base account in the sense that at the same point in time, it just jumps through the roof. Pretty much all the money that they got from the Fed, instead of lending it out, they just held it at the Fed. They were getting paid a small nominal interest rate on those excess reserves. But they had the option of taking it and lending it out, but they chose not to. And that held true really for the the next 10 years. The money in the excess reserves account, normally banks don't hold anything in the excess reserves account, but by 2010, they were holding 1.2 trillion. So most of the money they got, that's where it went. Now, why were they holding on to it? That then takes us over to the real side of the economy. And the story there was just that the banks were looking at the lending opportunities and evidently decided they would rather get a small interest rate from the Fed than put that money out into the real economy. People weren't borrowing, banks weren't lending. And so the money didn't cause inflation, basically because it never actually got out into the real economy. Now, over time, so the excess reserves account, it continued to grow up until the middle part of that decade. By 2015, it was over $2.5 trillion. And what was going on there was that the bank was still engaging in the central bank was still engaging in quantitative easing. They were still purchasing assets. Every so often, they would try to reverse gear. They would try to start selling assets and draw down their balance sheet. And every time they tried, it had really strong negative impacts on the stock market, and they would back off fairly quickly. So by the time you get to 2016, you've got $2.5 trillion in excess reserves, and I'm just looking at the number here, $4 trillion in the monetary base altogether. So $4 trillion in the monetary base, that's an increase of $3 trillion from before the financial crisis, and of that, more than $2.5 trillion never even went out into the economy. It's just being held in excess reserves at the central bank. Starting in 2016, the numbers begin to change a bit, and there, I think the story is that the real economy began picking up in a much more aggressive way. The Trump administration's tax cuts, their deregulation, they were actually generating real economic activity. Once real economic activity is expanding in a big way, then the banking system begins to draw down the excess reserves. They're starting to actually lend them out the door. And also the Federal Reserve was able to start selling some of its assets and drawing down its balance sheet. So up until 2020, there was a slow but steady reversal of operations that had really begun back in the financial crisis. But then in 2020, with the COVID crisis hitting, this is where, if you thought the numbers looked crazy in 2008, this is where they go really crazy. The central bank, the monetary base, by 2020, it was down to, I'm just looking at the numbers here, down just above $3 trillion. March of 2020, it gets pushed up to $5 trillion. So just under $2 trillion in money creation overnight in the winter of 2020. And again, most of that in the first instance went straight into the excess reserves account. So now here we are in the post-2020 period, a huge upward shock in the size of the money supply, dwarfing the response to the 2008 financial crisis. Velocity is not decreasing, so that's not going to take off the pressures. And although excess reserves jumped, it was sort of an A-frame kind of jump, and they began dropping really rapidly in 2020. And then the final piece of the picture here is the new administration taking a very different stance on energy policy, regulatory policy, handling of the supply chain crisis, all these real shocks that are all in the direction of stifling real economic activity. The stimulus program that precipitated an exodus from the labor market, for instance. So you have the Great Resignation, as it was called, now constrained labor markets, and all those things that essentially shift the supply curve back at a time when you've got a lot of money now shifting the demand curve out. So it's a totally different story now. And in the column that you read, when I got to the end, I made a passing reference to this modern monetary theory, which became popular, where I think some economists looked at the 2008 episode and, with a sample size of one, decided, okay, now we can rewrite all of monetary theory. And they took the wrong lesson from that. And we're now in a situation where classical monetary theory, I think, is the guide for what's going on. It's a huge expansion of the money supply. It's not neutralized by a reduction in velocity. It's paired with a lot of constraints on real output. And you have the classic Milton Friedman situation of too many dollars now chasing too few goods and services. And we can, if you want to know what's going on, really, we're back into a 70s style inflation. Next thing to watch for will be as it begins to affect wage settlements. My generation, when I grew up, we there was always strikes, industrial strikes, public sector strikes, post office is on strike, everybody's on strike. And the millennials and the Gen Z people, they've never seen that. They've never really seen an era of widespread strikes. And I think it's going to come as a surprise to people when the strikes start happening. And it's my sense that this is what's going to happen because the workers can see that they've just taken a real wage cut. They have lost a lot of purchasing power. They're going to want their employers to make up for it. Their employers are going to be looking at the profit margins and saying, well, we took a pay cut as well. So they don't have the money. And that leads to the collision of expectations. And then you've got strikes and lockouts happening. Anyway, that's my sense of where we are at and what's coming up.
Okay, well, thanks for that summary, Ross. So let me just, you have a lot there. Let me just unpack some of this. So I think one point I should make sooner rather than later before I forget is that the economists in the tradition of the Austrian School of Economics, they often stress the distinction between monetary inflation and price inflation, right? So historically, at least in the United States, the word inflation referred to an expansion of the money and or credit supply. And then it was only later during the 20th century that term came to be associated with rising consumer prices. And so, some of us are cynical and we think that was on purpose, that you're like subbing out the cause for the effect or the symptoms. And it makes it harder. Mises has some passages saying it's hard to understand, who to blame for rising prices when you can't even, when the very word you used to use to identify the cause, is taken out of the vocabulary. That now inflation refers to the symptoms, whereas again, in the late 1800s, it typically in the U.S. referred to expanding the money supply. So there's that element, but also I think because you were talking about stock prices, and so it's interesting that, and I think I probably fell into this trap too of saying, oh, after the rounds of QE, of quantitative easing in the United States, prices didn't really respond much. But what we mean is like gasoline or tuna fish, stock prices certainly responded. The price of mortgage-backed securities certainly responded. The price of treasuries responded. And so it's so I don't know if you consider that element of it, but I was wondering, is part of it might just be, like, in other words, it's not surprising that when the Fed comes in and gives a bunch of money to investment bankers, that they go out and buy assets with it, and that pushes up asset prices. And everybody agrees. Like, even the defenders of Bernanke said the point of this was to support the stock market, or that's one of the good results. And they're not going to go out and buy eggs and bread.
Yeah, well, in that sense, when the Fed takes action, it's technically they don't just give money to the banks. What they do is they buy assets from the banks. And traditionally, prior to 2008, the Fed really only ever bought either government treasury bills, government bonds, gold, very simple assets like that, on the thinking that the Fed has to know that it could turn around and sell those assets at par value anytime it wants. That's how it controls the supply of money, basically buying assets when they want to put cash into people's hands and selling assets when they want to pull cash out of the real economy. In 2008, another one of Bernanke's revolutions was they went to the banks and said, we'll buy anything. They created these holding companies called Maiden Lane and started buying equities, which they hadn't done before. And so as a result, that did go straight into the stock market and inflate asset values at a time when they were at risk of a widespread crash. As far as I know, and I haven't looked at the details of the Fed's holding, they're still holding equities and they're still willing to buy those kinds of financial assets that they didn't used to hold. It was very controversial at the time. I don't know if you remember when people like Ron Paul and let's see, what was it? Alan Grayson, I think, was the other guy. They sponsored a bill to audit the Fed because they wanted to have an external auditor go in and look at the balance sheet of what the Fed was holding and find out what the stuff is actually worth. Because the Fed buys it, they record it on their balance sheet at par value. But when you're talking about multiple trillions of dollars, that doesn't mean they have that much in assets that they could sell if they had to shrink the money supply. And so to your point, the Fed's actions really did directly feed into the stock market via the banking system. And at the time I was thinking, okay, if they're willing to buy anything, like I have a sofa in my basement, I could sell it to them for $10,000. So why don't we do that? And the transaction balances, I get 10,000, they get an old blue sofa that they can put on their balance sheet. And why not buy assets from everybody, from every small business? You know, everybody's got stuff they would happily sell to the Fed and then store it for them. Just call it excess reserves. And so if they had done that, then you would have seen that direct price inflation, prices of goods and services going up. Instead, it goes indirectly, first of all, through the assets of the financial sector.
So that's interesting. You say that because John, I don't know if you know who Jon Stewart is, the comedian who used to host The Daily Show.
Yeah.
And so he now has a podcast where he's more serious. I mean, he still like tries to be funny, but you know, it's more serious topic. And he had Thomas Hoenig on. I think he might have been the Kansas City Fed chief for a while. And he asked him precisely what you were saying. He was like, you know, especially in the wake of the financial crisis, if the ostensible justification for the Fed going out and buying mortgage-backed securities was to prop up the real estate market and to maintain the flow of lending into the mortgage sector, which is what they would, in other words, they weren't going to say, oh yeah, there's all these rich guys who are going to go broke, so we got to bail them out. That's not the official justification. Why are we buying mortgage-backed securities? And so Jon Stewart asked a pretty reasonable question. Well, if the reason for that was to like prop up the failing real estate market, why didn't the Fed just go around and buy up houses that were underwater directly from homeowners? And you know, and Hoenig kind of gave like, and you know, there'd be moral hazard, and you know, and it wasn't that there's anything wrong in his explanation as to why that would have been a bad policy. I agree with him. That would have been crazy if the Fed just went around and bought houses off people. But it raised the question, but then how come they were okay buying mortgage-backed securities? Like all of a sudden it's like, well, the whole system's at stake, so we got to bail out, you know, these investment banks. And so it was funny. Sorry, go ahead.
If they had done that, it really would have closed the circle of government intervention in your household, in your mortgage financing system, because in the lead up to the financial crisis, one of the drivers of the creation of this shadow banking system with all these mortgage-backed securities was the federal rules that required banks to do a lot of lending activity in specified areas where they have to overlook bad credit scores and just meet social targets for lendings. And that was only viable for the banks because the banks figured out they could originate the loans, meet the quotas, and then flip the loans into these mortgage-backed securities, which ultimately were backed by Fannie Mae and Freddie Mac. So then other buyers are willing to put their money into them. So you have this federal intervention at every stage along the way. And the result was this massive buildup of risky mortgage assets. So then if at the end of that, the Fed rushes in and bails everybody out, it kind of would, like I say, just close the circle of this disastrous process of intervention all along the way.
Right. Yeah. So that's, I mean, and a lot of people pointed this out, especially after the fact, but some of us, you know, Mark Thornton and Ron Paul being good examples. Mark Thornton is a senior fellow here at the Mises Institute. We're pointing at, you know, during the real estate housing boom in the mid 2000s that, hey, these government policies are encouraging too many people to get into into real estate, and it's, the banks are lowering their lending standards because of these policies, and it's sort of a if like for us to understand after the fact, because some of these things were crazy, like. There's famous anecdotes about banks that they called them liar loans. I don't know how prevalent this was in Canada, where somebody would apply for a mortgage on a piece of property, would make up their income. They wouldn't even be employed. The lender knew full well they were lying, but they didn't care because, like you say, it was a rising market. Worst case scenario, if they're still holding the mortgage, they just sell the property, which probably has gone up 10% in the last year. Or ultimately, they would sell the mortgage, to these Wall Street firms. But all along the way, you wonder, why wasn't somebody, like at some point, somebody's going to be left holding the bag? And then the answer to that was, but if you knew the central bank, following the experience of Alan Greenspan, his famous Greenspan put, if you thought the central bank was waiting in the wings and they wouldn't let the system implode, then you could say, well, let's ride this tide while it's going up, and we'll private profits and then public socialized losses once we get bailed out.
Yeah, we didn't have the same degree of crisis here in Canada, and I think part of that was we didn't have the development of these credit default swaps, which were a big factor in the expansion of low-quality mortgage-backed security combined assets. So the credit default swaps were basically insurance policies on various tranches of these investment products. And they were structured so that the buyers of these products were actually hoping that they would fail because they were overinsured through credit default swaps. Credit default swaps was another one of these parts of the shadow banking system. Basically, companies selling insurance on assets, but because it wasn't called insurance, they weren't subject to the regular rules. Like you can't, if you have a house worth $200,000, you can't take out $10 million in insurance on it, because then obviously you've got an incentive to burn your house down. But there are no such limits on credit default swaps. And so they would bring in asset classes, credit card debt, student loans, stuff like that, mix them in with mortgages, and then overinsure them with credit default swaps. The weakness in that whole system was the people selling the credit default swaps didn't have the reserves to cover them, because at the time everybody thought, well, these mortgages will never fail. Housing prices will always go up. If someone's got a teaser rate mortgage, $888 a month for the first year, and then it goes up to $3,000 a month, no problem. They just sell it at the end of the year, make some money, and reset the clock on it. But when it did start failing, there was no money for these credit default swaps. And that was one of the things that suddenly caused everybody to write down the value of these assets. And so the guy at the Federal Reserve, I can see his point that they probably realize, fairness would dictate we should go and bail out the homeowners at the other end of the chain who are underwater on this. But our immediate concern is we have a banking system that if they were going to true up their books, they would have to call in 30 or 40% of outstanding loans later today. And if you do that, then you have a complete collapse of your economic system. So that would have been all they could think about at the time.
Yeah, just to follow up on a couple of things you said there. So when I looked at after the financial crisis in 2009, 2010, and I was just interviewing various people and just trying to figure out. So yes, of course, I'm skeptical of the central bank, and I think that's ultimately if you had to blame something, that explains the boom in consumer or house prices in the mid 2000s, and those programs you mentioned. It's funny that when those programs were working, like in 2003, George W. Bush, the U.S. president, that he was very proud to say, "Oh yes, we're trying to restore the dream of every American owning their own home." So they were happy to say that our programs are allowing people to get into houses who the free market wouldn't have allowed to.
Right.
Then all of a sudden after the crash, it's like, no one should blame our policies. It's not like that had anything to do with it. It was the greed of the investment banks or whatever.
Right.
Or it was the deregulation of 1999 or something that caused this. So that was kind of funny that what they thought their policies did flipped depending on whether it was perceived as good or bad. But besides that, there was an intellectual mistake that they had these physicists coming in at these investment banks and running the models that would price, like you said, these various tranches of issued on mortgage-backed securities. So it was the kind of thing, like for folks at home, if you just picture like a bucket And so there's little bits of, like, there's 1,000 different mortgages spread around the country. And rather than an investor buying just, one mortgage here and one mortgage there, where if that particular homeowner defaults, then oops, your cash flow dries up. It was like they took little bits of mortgages from 1,000 different mortgages and put them into this one asset. And then as the payments came in each month, you picture it filling up a bucket. And so if you were an investor, like, they would sell slices of that bucket. And so the bottom slice was considered very safe, because it was like, well, gee, 800 out of the 1,000 people would have to fall behind on their mortgage payments for that bottom slice or tranche to not get paid. And so that's why those mortgage-backed securities were rated AAA. And so the intellectual mistake was they did know that the real estate market was volatile, and they knew home prices could collapse, because historically they had data on that, but they thought real estate was local. So they knew the Miami market could go down 10%, and they had a probability for that. And they even, were conservative and made the probability bigger in the stress testing than historically it had been. There could be a 3 standard deviation event or whatever. But again, they thought if the Las Vegas market crashes, that should be an independent statistical event from the Phoenix market collapsing or from Miami collapsing. And so the chance of all these major markets going down a lot simultaneously, they thought should happen once every 10,000 years. Because to them, it was like flipping a coin and having it come up heads 10 times in a row, not, there's some systemic cause that's making the coin come up the same across all the coin tosses.
Yeah, at the time, in early 2008, I'd never looked at any of this, but a friend of mine who's a finance prof who specializes in risk management, we were at a conference, and he just began talking about these issues. And what he was frustrated about was that, yes, there's people in the risk management side that are purely quantitative, great at number crunching, physics background, all the rest of it, which is important. But looming over all of that were these crazy institutional arrangements, which were creating a lot of bad incentives. And so this friend of mine, he was already worried about, I don't really care what the number crunchers are saying at this point. The system itself is badly set up, and it's leading to we're going to have a major credit event happen, or a credit crisis turned out to be the case. Now, I think in the aftermath, though, because there was this really 8 or 10 year period where a lot of indicators pointed to, well, the next bad thing is going to happen, the next shoe is going to drop, and it never dropped. And so you get back into this complacency that people say, well, money creation isn't inflationary, so let's run deficits. And the banking system is stable, even though property prices are volatile. So we should allow the shadow banking system some room to start rebuilding these mortgage-backed securities and trading them. I don't know if there were ever any of the proposed reforms to Fannie Mae and Freddie Mac as far as limiting the taxpayer exposure to what they're doing. It was never supposed to be a taxpayer bailout of those enterprises, but so many of those assets were held by foreign governments that the U.S. government, the Treasury, pretty much had to go and say to them, please don't dump these securities. If need be, the taxpayer will make you whole again.
Yeah, there was a lot of moral hazard there, and you're right that the status of some of those things in the mid 2000s, they were called government sponsored enterprises, or GSEs, and there had not been, depending on which program you're looking at, an explicit guarantee of a backstop by the federal government. But a lot of investors thought, if this market gets into trouble, if these mortgages that are backed up by these GSEs, surely the Treasury would step in and backstop them, and so they were trading at a premium, and there's lots of statistical analysis. And again, it was funny. I don't have the specific numbers at my disposal, but I remember Paul Krugman at the time was trying to argue that no, Fannie and Freddie had nothing to do with this, and then there were the other economists coming in and just picking apart everything he would say and say, no, that's not. Look at the origination started here, and then it spread to the broader market, and so on. So it's that, yes, and like I said, back when things were going well, all of the interventionists were happy to credit these programs for their avowed purpose. I mean, it's like,
right.
why have Fannie and Freddie if you think the market allocates mortgages properly? The whole point was to get people into homes who otherwise wouldn't qualify for a mortgage. And so it's it's kind of hard to then after the fact, when clearly too many people were getting into houses or they were getting it at prices that were unsustainable, that to say, well, our policies had nothing to do with that. Another thing too, just a loose end, you mentioned, Ross, that in 2008, the Fed changed the type of assets it was acquiring and adding to its balance sheet, and they created these maiden lane corporations. Part of that they had to do for legal reasons, for statutory reasons. And folks, my book, Understanding Money Mechanics, that the Mises Institute puts out, I talk about this in one of the chapters, is because the Fed was not allowed to own. I mean, if you just think about, the possibility of corruption, Ross, they wouldn't want the Federal Reserve to just be able to buy mortgage-backed securities issued by, that's some company, that some investment firm's in trouble, and the guy at the Fed used to work there, and he just, oh yeah, we'll buy that asset off your books, don't worry about it. To guard against that, they had rules about what the Fed was allowed to buy. And so the way they got around that was they created these maiden lane LLCs. The Fed lent money to the LLC, and then the LLC went out and bought the actual asset. And so the Fed could say, oh, we're allowed to lend freely. We didn't buy those assets. We just lent money to this LLC. We didn't buy some mortgage-backed security. But like you say, on the Fed's books, it shows up as assets held on the balance sheet. So it is, sort of this nod and a wink. And so I think, the big picture in terms of why is it important for us to understand what happened is, as you say, because following, the warnings, and I was guilty of this myself, that, I was worried and warning about consumer price inflation in 2009 and 2010, and it looked like I was Chicken Little along with, some other people. And so you're right, like this fueled the ascendancy of so-called MMT, modern monetary theory types, who are arguing, these economists have their gold standard era thinking. That's not the way the world works anymore. And look at all this boatloads of money of QE that came in. If you had listened to these conservative fuddy-duddies, we wouldn't have done these programs, and we'd be in the Great Depression 2.0 right now. So thank goodness Bernanke, he didn't do enough, they said, but at least, he pumped in a bunch of money, and it's a good thing we didn't listen to these guys who were saying that was going to cause prices to explode. So now, at least we can say, and that's kind of like I say it tongue in cheek. I documented like guys like Paul Krugman and then Scott Sumner. I don't know if he's on your radar up there, Ross, but they favor what's called NGDP targeting. They're called market monitors. So to be clear, these are distinct from the MMT people, but they also, Krugman, representing the Keynesians, and Sumner representing the so-called market monetarists. Also in 2009, 2010, were running victory laps saying, see, we knew this QE wasn't going to cause price inflation, but they didn't see this recent bout of inflation coming. So now it's sort of like, well, everybody's wrong. You know what I mean? Like the public, at least we can say, yeah, we were wrong back in 2009 about warning about massive price inflation at that point. But, these other schools of thought who were running victory laps at the time, they missed what just happened. So the world is very complicated at the very least.
Yeah, and at the time when inflation didn't appear after 2008, and we years go by and it's not there, I could see what you're mentioning, that some people taking the victory lap and others saying, oh, it's coming any minute now. I looked at that and I thought, okay, if I take the first group seriously, if they're saying, this is old gold standard era thinking, these old fuddy-duddies, we're onto new clever versions of monetary theory where inflation doesn't happen, then my question would just be, well, then why do we still have income taxes? Why do we have sales taxes? If we can create money at the central bank and it's not inflationary, then let's go for it. And but when you put it in that way, then even the people on the expansionary side would say, well, you can't actually do that. I mean, that they would sort of hit the wall as far as what economics really allows. And so that was kind of the question for me at the time. And when I went through the Federal Reserve accounts, and I did a bit of writing on it at the time, that's when I saw, and it's not like it takes any deep research to discover, but this excess reserve account was just taking all the money, and that's why it wasn't circulating. And I've given reasons why I think the banks were holding on to the money rather than lending it all out. I don't think I fully understand that story about why it sat there. Um, Now, moving to the COVID era, one of the other unusual moves that the Fed made in March 2020 was they they looked at that excess reserve account and then they decided, reserve requirements don't make any sense anymore. The banks are holding so much in excess reserves, um, and they just eliminated reserve requirements altogether, which um, isn't as radical as it sounds. We don't have reserve requirements in Canada. This traditional idea that you deposit $1,000 in the bank and the bank can lend out 900 and has to keep 100 in reserve used to be like that, but um, in Canada the rule is the bank can lend the whole thing out if they want, but they have targets they have to meet in terms of the size of their loan portfolio to the value of the capital value of the bank itself, and so they're not unlimited in how many loans they can create from a deposit. And you have had in the U.S. standard reserve requirements, which varied by the class of bank. But in March 2020, the Federal Reserve just eliminated them all. I I assume, although I haven't confirmed this, that they have in place of that they've put capital requirements in that put other limits on what the banks can do. But the other chart that's there on the Federal Reserve site is the size of deposits in the banking system. And in the winter of 2020, those jumped, which happened in Canada as well because people couldn't spend their money. Lockdowns happened, so people just started putting their money in savings accounts. Um, but after that jump, the trajectory of the deposits began going up. So it had been pretty flat, but it's began going up, and that means okay, now these excess reserves are beginning to get into the banking system in the form of deposits, in the form of loans, um, and you can see the corresponding rapid drawdown of excess reserves. Interestingly, though, I like that's a number I like to follow. Except the bank discontinued that series after they decided, well, we don't have reserve requirements, so there's no such thing as excess reserves anymore. So they don't publish that number. But you can see at the tail end of that series, it's dropping like a stone, and the volume of deposits in the banking system was beginning to go up pretty rapidly and continues to. And really, that's where the connection is made now to this huge increase in the money supply, and now it's getting out into the real economy in the form of spending. And this is where the challenge for the Federal Reserve, in the end, it's a very simple. Mathematically, it's very simple. Politically, economically, it's extremely hard. But mathematically, what they have to do is start selling assets. They have to um, take some of these holdings that they have and start auctioning them off. And in the language of the newscast, people are used to hearing about quantitative easing and tapering, and this is tapering. They have to begin shedding some of these assets. Same with our bank here, the Bank of Canada. The numbers are much smaller, but they went, I believe, it was from 200 billion to about 500 billion in the monetary base. Since December of last year, they've drawn that down by about 20 billion. The last time I checked, so some moves to sell assets start withdrawing cash from circulation. They have a long way to go, and the big question is just going to be, what are the terms that the market's going to demand to buy those assets back from the bank? And the reason it connects directly to interest rates is if the bank wants to sell a lot of bonds, it would be like if they were holding a whole bunch of old sofas instead of bonds and cut the price on the sofas just to get them out the door. They cut the price on the bonds. That's the same as raising the interest rate that's paid on the bonds. And so right now, the big question of people observing all this is if we're going to start getting inflation back down into the target zone, how high do interest rates have to go? And our immediate historical precedent for that from the 80s and 90s is, well, you at least have to get positive real interest rates. Like right now, you got negative real interest rates. So we're in fact in a monetary expansion mode that way, with the nominal interest rate well below the consumer price index. So they at least have to get to positive real interest rates. So we'll see. I mean, it does come down to how readily the central bank can sell this stuff that they're holding as assets. But that's kind of what we're looking at, given the situation that's been created.
Okay, yeah. Let me. So yeah, your point's well taken there. Let me push back a little bit, Russ, because I just want people to know the exact situation, because I want to explain too partly why I, up until recently, was a little bit unsure of my footing when trying to understand this. What happened in 2008 and 9 versus now, and so to be clear, yes, I agree with the spirit of what you were saying, that when the Fed pumped in all of these reserves in the QE program, most of it just piled up as excess reserves in the banking system. But enough of it did trickle out that the money held in the hands of the public did go up, at least in the beginning. So just to give you an example, so and I just have these at my fingertips because I just wrote up a piece on this. So so if we're looking at what's called M1, so for folks at home, that's like actual currency, $20 bills, $100 bills, plus checking account balances. When you go to your ATM and you put your card in, what's my balance? You add up all those numbers that everyone holds, and that's what M1 is. So that went up during the calendar year 2008. That rose more than 20%. Yeah. And to give a frame of reference, it was roughly flat in 2006 and 2007. So I'm talking here about U.S. data. So again, if that's like a narrow measure of money that the public holds, it was pretty flat in 2006, 2000, and then a rate rises 20% just in 2008. So looking at that, one might have thought, oh wow, that's the public has more money, but then if you look at the next level, and this is the last one you got to remember, folks. Don't worry, we're not gonna quiz you on this after, but it did help me to kind of see the distinction between the two episodes of what's called M2. Which is, it includes everything M1 does and some other things too that are less liquid, in particular retail money market funds. So that's a part of M2. And if you look at that measure, M2 did not grow significantly. There was nothing unusual about M2 growth after QE, in 2009, 2010, whereas it jumped a lot following the coronavirus pandemic.
Right.
Okay. So what I'm saying is, looking at that broader measure, when you're trying to understand how come price inflation's hitting like crazy now, consumer price inflation, but not then. If you look at that broader measure, for example, M2, then you do see that, oh yeah, money did not grow at an unusually high rate following, the financial crisis, whereas it did this time around. So it kind of makes sense. That's why consumer prices go up. So to understand, so what was going on following the financial crisis, retail money market funds collapsed about 20%. Like about $200 billion. They were about $1 trillion in the start of 2009, and then during the course of the year, they fell about $200 billion. So intuitively, I think what was happening is, after the panic in the fall, and remember like certain things broke the buck and stuff like that, people were like, "Oh, is my money safe? I don't even know where to put my money," and so they were rushing. And also, a policy change was FDIC bumped up how much they would insure checking account balances. That going into it, I think it was $100,000, and they bumped it up to $250,000 guaranteed per checking account. And so I think there was a rush of wealthy people to move their money out of money market funds, and that happens during recessions. That's standard, but it was particularly pronounced following the 2008 crisis. And so, whereas it didn't happen as much following the 2020 crisis. So yeah, people were panicked, but they were like buying toilet paper. They weren't moving their money, into checking account balances as much. And so I think that's partly like a way to see, yeah, the Fed was pumping in money on its end, but the public was really hoarding money, in particular following the financial crisis. And so like looking at the difference between M1 and M2 growth, for me at least, kind of helped clarify and quantify those different effects.
Yeah, they were two very different shocks to the system. The financial crisis in 2008 really was an asset shock in the sense that all these entities that thought they had, okay, here's $100 billion asset on our books, and poof, we discovered it's only worth a fifth of that. And
Right.
in the case of the 2020 shock, it was, we're going to lock everybody's front door and not let them go to work for a few weeks and shut down big sections of the economy. So it was a supply side shock in
Mm-hmm.
that sense. And so in Canada, for instance, we have, like you guys, we have very low savings rate. And but 2020, the savings rate went through the roof because
Mm-hmm.
people were still getting paychecks, but they weren't spending it on travel and couldn't really spend it on much. So they just put it in savings accounts, and savings rate went through the roof. The other shock in 2020, and I remember at the time thinking, okay, the chickens are going to come home to roost. We're paying all these people to stay home, paying all these small businesses, medium-sized businesses, shut your doors, but keep paying your workers. So everybody's still eating. They're still heating their homes. They're still buying stuff on Amazon, and nobody's working. And um, yes, the government's mailing checks out so that people are paying their bills, but from a real economy sense, this doesn't add up. I mean, one of the iron rules of economics that you can never violate is costs can be shifted, but they can't be avoided. And so I at the time when I was looking at this, I thought, okay, I can see the rationale for what they're doing here, but we have to realize these bills are going to come due, and how are we going to pay for it? That's the big question. And my worry at the time was the easy default here is we pay for it with inflation,
Mm-hmm.
and inflation is this horrible form of taxation. It's regressive, it's random, it causes all kinds of real disruptions in the economy. It would have been much more honest for the U.S. government, Canadian government to come out and say, in 6 months we're going to start hiking consumption taxes or income taxes, or put surcharges on things. We got to pay all this money back, and they didn't. And instead, what we're effectively doing is paying for it with inflation, and
Mm-hmm.
so it is it's a cruel, it's an unfair form of taxation. And now we're seeing kind of the musical chairs where everybody is going to try to protect the purchasing power of the money they do have, because you don't want to be the one left standing when the prices are posted up and you see what your assets are worth and what the cost of things are.
Sure, sure. And you kind of walked into. I'm glad you went that route with it, because there was one last thing. We'll just go a few more minutes here, folks. But one last thing I did want you to emphasize, Ross, because it highlights the difference in Keynesian thinking versus like more classical or Austrian or even like Chicago school type real analysis. Is that, Ross, when you were saying the the program to give people compensation for them staying home from work, to support people while they stayed home, that a Keynesian analysis is like, oh, that contributes to inflation, to price inflation, because, oh, you're giving money to people and they go out and spend it. But you kept stressing, well, no, if you're paying people to not go to work, then they're not producing goods and services, and that's gonna, other things equal, tend to raise prices. So can you just again explain that distinction? Like, how is it that paying people not to work makes prices higher in general?
Yeah, if people have a supply demand diagram in mind, paying them not to work means shifting the supply curve back. So if the demand curve doesn't move, then you have to move up to higher prices. If people for a while at least, if they still have the same purchasing power, if they think they do, as they had last year, but there's 30% fewer goods on the shelf, then the prices start going up. But gasoline's a good example, for instance. If what drives the price of gasoline up is that gas station knows it's got to phone its distributor and get the tanks refilled, and they're price takers. So if they know, like if they're charging, if they think gas, they're charging $3.50 a gallon, but then they phone up and find out that the refill is going to be $4 a gallon. They have to put their price up. They can't sell gas at $3.50 a gallon that's going to cost $4 to replace. And so the supply shocks sort of way back in the system where the quantity is now smaller. There's less quantity, but there's still as much demand for it. That at some point in the system, the response has to be, all right, well, we have to put the price up because we don't have as much to sell. And from that point on, other people are putting the price up because their input costs are going up. And so this transmission of price shocks through the system, if it's a supply side event, it's happening because people's input prices are going up. So they have to raise their prices in order to cover that. I remember when I haven't studied a lot of monetary theory, but one of the essential elements of inflation is money illusion. That the first thing that happens in an inflation episode is people suddenly feel like they're getting paid more for the stuff that they used to sell at previous prices. It's like demand is picked up. And so there's this illusion initially that people think their assets are actually worth more and they can raise their prices in the stores because demand is higher. But that's really just, it's like the tsunami. The first thing that happens, it looks like the water level goes down, so the beach is bigger. But what's actually coming is going to be the opposite, which is what we're into now. That it's not that the economy is stronger and demand has gone up. It's that there's an inflation shock that's coming in.
Mm-hmm. Well, yeah, and that dovetails nicely with the Austrian analysis. So folks at home have probably heard this before, but just to reiterate that the problem from the Austrian perspective, this is the theory that Ludwig von Mises developed and Friedrich Hayek elaborated on, is that the problem when the banking system floods the market with new money, it's not just inflation, like it's not just rising prices and that screws things up. It's that the specific way that comes in through the credit markets distorts interest rates and makes businesses feel wealthier, feel like credit's available on easier terms than it really is. And then and like you say, Ross, that at the beginning during the upswing and the boom, entrepreneurs, people who own factories and whatnot, they feel wealthier. It looks like they're confusing it. They think that this is, my product is really good or valued by the public, when really it's just this general infusion of money that's not corresponding to real changes or fundamental changes. And so then that leads to what's called capital consumption, where they're not reinvesting enough back in the business because they're not correctly anticipating, how much these tools and machinery that we're using up right now in current operations are going to cost to replenish. And so we're taking too much what we think is profit and then going and, splurging or buying new jewelry for our wives or something or husband, if it's a female-owned business. That's the mistake they make. And so there's real what's called malinvestments during the boom, and you can't just flip that on a dime and turn it off afterward. If genuine mistakes were made and people consumed too much because they falsely believed they were richer than they really were during the boom, then there's going to be pain at the bust, and there's no policy that can change history.
Right. Mm-hmm.
Okay, well, I think that's a good spot to wrap up. Hopefully folks at home, have a better sense now of what happened and why the monetary spigots being opened in 2008 and 2009 didn't lead to gasoline skyrocketing at the pump the way it has this time around. My guest has been Ross McKitrick. So Ross, thanks so much for your time.
Thanks, Bob. My pleasure. We'll talk again.
Okay, then folks, thanks for tuning in, and Jeff should be back next week, and we'll see you then.
Check back next week for a new episode of the Human Action Podcast. And in the meantime, you can find more content like this at Mises.org.